Dividend stocks for a volatile July. With summer heating up and market volatility on the rise, dividend stocks can be a stable anchor for your portfolio, offering steady income and potential growth. In this video, we'll explore why dividend stocks are a smart choice right now, highlight top dividend stocks for July 2025, and back it all up with detailed data and numbers. Whether you're a retiree seeking passive income or a long-term investor looking to compound returns, this video is for you. So, grab a notebook, hit that like button, and let's get started. First, let's talk about why dividend stocks are a great fit for a volatile market, like what we're expecting in July 2025. Markets have been choppy lately. According to CNBC, the S&P 500 and Nasdaq have both seen declines of over 10% from their 2024 peaks due to uncertainties around U.S. tariffs, trade policies, and global economic shifts. Geopolitical tensions and potential trade wars are pushing investors toward a risk-off approach, favoring stable investments like dividend stocks. Dividend stocks provide two key benefits. Regular income. They pay you cash, typically every quarter, which can be reinvested or used to cover expenses. Stability. Companies that pay consistent dividends are often financially strong, with predictable cash flows, making them less likely to plummet during market downturns. For example, a 2023 study by Hartford Funds showed that dividend-paying stocks have historically outperformed the S&P 500 with less volatility. From 1973 to 2022, dividend growers and initiators returned 10.2% annually compared to 7.7% for the broader S&P 500. That's a powerful edge for long-term investors. In a volatile July, dividend stocks act like a financial cushion. Even if stock prices dip, those dividend payments keep coming, providing income and reducing your reliance on selling shares at a loss. Plus, reinvesting dividends can compound your returns over time. For instance, a $10,000 investment in an S&P 500 index fund in 1993 grew to $182,000 by 2023 with dividends reinvested, but only $102,000 without them. Now, let's dive into 5 dividend stocks that U.S. investors should consider for July 2025. These picks are based on strong fundamentals, sustainable dividends, and resilience in volatile markets. I'll break down each stock with detailed data, including dividend yield, payout ratio, and recent performance, so you can make informed decisions. Our first pick is Chevron Corporation, ticker Chevron, a blue-chip energy giant with a rock-solid dividend history. Chevron is a leader in oil and gas, with diversified operations in exploration, production, and refining. Why Chevron? Chevron's dividend is a cornerstone for income investors. As of June 2025, Chevron offers a dividend yield of 4.2%, paying $1.63 per share quarterly or $6.52 annually. The company has raised its dividend for 37 consecutive years, earning it Dividend Aristocrat status. Its payout ratio is a conservative 42%, meaning Chevron pays out less than half its earnings as dividends, leaving room for reinvestment and resilience during energy price swings. Recent performance. In Q1 2025, Chevron reported earnings per share of $3.14, beating analyst expectations by 8%, driven by strong production in the Permian Basin. Revenue was $49.8 billion, up 3% year-over-year, despite volatile oil prices. Chevron's AA credit rating and low debt-to-EBITDA ratio of 1.2 signal financial strength, making it a safe bet in uncertain markets. Why for July? Energy stocks like Chevron are less sensitive to trade war fears, as global demand for oil remains steady. Plus, Chevron's long-term contracts and diversified assets provide stable cash flows, supporting its dividend even if oil prices dip. At a share price of around $155 as of June 2025, Chevron trades at a price-to-earnings ratio of 12.5, below the S&P 500 average of 22, making it undervalued. Next up is Realty Income, ticker O, a real estate investment trust, or REIT, known as the monthly dividend company. Realty Income owns over 12,000 retail properties across the U.S., leasing to stable tenants like Walgreens and Dollar General. Why Realty Income? As of June 2025, Realty Income offers a 5.7% dividend yield, paying $0.263 per share monthly or $3.16 annually. That's ideal for investors seeking frequent payouts. The company has paid uninterrupted dividends for 56 years and raised them for 29 consecutive years. Its payout ratio is 70%, sustainable for a REIT, as they're required to distribute at least 90% of taxable income. Recent performance. In Q1 2025, Realty Income reported adjusted funds from operations of $1.05 per share, up 5% year-over-year, with occupancy rates at 98.6%. The company acquired $500 million in new properties, expanding its portfolio. Its BBB plus credit rating and diversified tenant base reduce risk in a volatile economy. Why for July? REITs like Realty Income thrive in volatile markets because their long-term leases generate predictable cash flows. With consumer spending holding steady in retail sectors, Realty Income's tenants are resilient. The stock trades at $55, with a price-to-AFFO ratio of 13, reasonable for a high-yield REIT. Our third pick is Southern Company, ticker SO, a leading utility provider serving 9 million customers across the Southeast and Midwest. Utilities are a classic safe haven in volatile markets, and Southern delivers. Why Southern? Southern offers a 3.2% dividend yield, paying 72 cents per share quarterly or $2.88 annually. As of June 2025, it has increased its dividend for 23 consecutive years, with a payout ratio of 65%, indicating sustainability. Southern's BBB plus credit rating and regulated business model ensure stable cash flows. Recent performance. In Q1 2025, Southern reported earnings per share of 90 cents, up 10% year-over-year, driven by strong demand and infrastructure investments. Revenue was $6.8 billion, up 4%. Its focus on renewable energy, like solar and wind, positions it for long-term growth as the U.S. transitions to cleaner energy. Why for July? Utilities like Southern are defensive stocks, meaning they hold up well during market downturns. With trade policy uncertainties looming, Southern's regional focus and essential services make it a low-risk choice. The stock trades at $90, with a P/E ratio of 20, in line with utility peers. Number 4 is Lockheed Martin, ticker LMT, a defense contractor with a strong track record of dividend growth. As the largest defense company in the U.S., Lockheed benefits from stable government contracts. Why Lockheed Martin? Lockheed offers a 2.7% dividend yield, paying $3.30 per share quarterly or $13.20 annually. As of June 2025, it raised its dividend by 5% in 2024, marking 22 years of increases. The payout ratio is 50%, leaving room for future hikes. With a fair value estimate of $539 per share, the stock trades at $490, about 10% undervalued. Recent performance. In Q1 2025, Lockheed reported revenue of $17.2 billion, up 6% year-over-year, with earnings per share of $6.50, beating estimates by 5%. Its backlog of contracts is $160 billion, ensuring long-term revenue. Why for July? Defense stocks are insulated from economic volatility due to government spending. With geopolitical tensions rising, Lockheed's contracts provide predictability. Its wide moat and conservative balance sheet make it a safe dividend play. Our final pick is Verizon, ticker VZ, a telecommunications giant with a high-yield dividend. Verizon provides essential services like wireless and broadband, making it a staple in any income portfolio. Why Verizon? Verizon offers a 6.1% dividend yield, paying 67 cents per share quarterly or $2.68 annually. As of June 2025, it has raised its dividend for 19 consecutive years, with a payout ratio of 55%, indicating sustainability. Verizon's BBB plus credit rating supports its ability to maintain dividends. Recent performance. In Q1 2025, Verizon reported revenue of $35 billion, up 3% year-over-year, with wireless subscriber growth of 1.2 million. Earnings per share were $1.15, in line with expectations. Its 5G expansion continues to drive growth. Why for July? Telecoms are recession-resistant, as consumers prioritize connectivity. With a share price of $44, Verizon trades at a P/E ratio of 9, significantly below the S&P 500, suggesting it's undervalued. Before you invest, let's address risks. Dividend stocks aren't risk-free. Market volatility. Even stable stocks can dip in a bear market. Diversification helps mitigate this. Dividend cuts. Companies can reduce dividends if earnings drop. Stick to firms with low payout ratios and strong balance sheets, like our picks. Taxes. Dividends are taxed as ordinary income unless held in a tax-advantaged account, like an IRA. Qualified dividends may get favorable tax rates, but short-term strategies like dividend capture face higher taxes. Opportunity cost. Dividend stocks may lag high-growth tech stocks in bull markets. Balance your portfolio to capture both income and growth. Always do your own research and consult a financial advisor to align your investments with your goals. As we head into a potentially volatile July 2025, dividend stocks like Chevron, Realty Income, Southern Company, Lockheed Martin, and Verizon offer U.S. investors a way to generate steady income while cushioning against market swings. These companies combine strong fundamentals, sustainable dividends, and resilience in uncertain times. Start building your dividend portfolio today, diversify across sectors, and reinvest those dividends to grow your wealth over time. If you found this video helpful, give it a thumbs up, subscribe, and hit the bell icon for more investing tips. Share your favorite dividend stocks in the comments below. I'd love to hear your picks.